Hello and welcome to Amagi, co-hosted by myself, Dylan Moore of the Volitional Science Network, which you can find on YouTube, and Nima of economicsjunkie.com. We are here to tackle ideas both ancient and modern in an effort to bring you the tools needed to expand the power of your worldview, making you a more potent entity, professionally, politically, philosophically, or otherwise. We are graciously being hosted by the Think Liberty Network, which you can find at think-liberty.com. And this episode is entitled Long-Term Yields versus Peter Schiff. So we're back from a little bit of a hiatus. Nima has been throwing himself across the country in an effort to get away from mountainous piles of tweaker dung in San Francisco.
I'm trying to get out of the People's Republic of San Francisco. That's what you're trying to say.
So, are you admitting to treason, saying that you don't want to pay for illegal aliens' full ride healthcare?
Yeah, I guess I'll have to plead guilty on that.
Okay, well, I mean that's at least 20 years of hard labor in Gulag. So, well, I guess we'll see when you get out.
Oh, well, yeah. I mean, it should be fun. Fun times.
Yeah. So, Nima was shooting me some stuff earlier today, saying that he wanted to talk about long-term yields. And we're talking about bonds, of course. And, Nima, what got you thinking about the subject that would put the most of the rest of us to sleep? And
well,
why shouldn't it put us to sleep?
Well, it's a pretty important financial figure to look at. Number one, most people, when they buy homes, they get a 30-year mortgage, and that 30-year mortgage is directly impacted by the long-term yields on treasury bonds, particularly if it's a 30-year mortgage, then the 30-year treasury bond, which has been hitting new multi-year lows. I believe on May 1st, the 30-year treasury bond hit 2.58%, and the last time we saw that level was around October 2016, so something like a 2.5-year low. And that, of course, flies in the face of the usual predictions that rates inevitably have to go up any time now, any day now. And we discussed before those funny tweets that Peter Schiff sends out just in hopes that he'll be right one day, such as the one where he said the yield on the 30-year treasury bond just hit a new 4-year high today, and yields have a long way to rise and will do so quickly.
Wasn't that like last year?
This was on September 19th, 2018. And yields were at 3.24%, and it's now June 2019, and yields are at 2.58%. So if he'd said the opposite, he would have been right. So I guess we can give him that. But, I mean, he's been so spectacularly wrong on that. And that goes back to...
But Nima, he predicted the 2008 crash.
Right. What do you say about a clock that's...
correct.
That's correct twice a day?
Yeah. I guess if you're just saying, like, every breath that comes out of your mouth, there's going to be a crash, at some point you will be right.
Right. If you have a recession Tourette's, then one day you'll be right, basically. So, number one, so mortgage rates are impacted by that, and mortgage rates are coming down quite significantly. The latest reading is 3.82% on a 30-year mortgage. And another factor as to why this is relevant is because we've talked about the investment strategy known as the permanent portfolio on this show before. And the permanent portfolio consists of four assets, stocks, bonds, gold, and cash. And the bonds in that portfolio are the long-term government bonds. So in the case of the U.S., it's a 30-year Treasury bond. If you're in another country that has longer-term bonds, then you should get those for that particular allocation of that portfolio. Why is that? Because when rates come down, then the longest-term bonds. When rates come down, especially when stocks crash, when you get into deflationary scenario or depression or recessions, the longest-term government bonds perform the best, and that's when you need them. And even right now, they're doing very well, while stocks are also close to new all-time highs, which is probably most likely due to inflation remaining pretty low and not picking up as previously expected. And long-term rates are basically kind of like a prediction of where short-term rates are expected to be going within their maturity. So the 2.61 rate on 30-year Treasury bonds basically tells us the market should government treasury bills over the next 30 years will be somewhere around that level.
That's the guess, right?
Exactly. That's the bet right now. And it's based on, people putting their money where they think the rates are going. And in particular, the most liquid, largest market in the world is the market for U.S. Treasuries. Or at least one of the most liquid markets in the world.
So I have two questions for you, Nima, if I may interrupt. The first one is, what do changes in long-term yield rates actually tell us about the economy, in contrast to my second question of what does everybody think they tell us about the economy?
Well, you read a lot on the financial news that when long-term rates come down and go below shorter-term rates, for example, then that is what's called a yield curve inversion. And that has been a more or less potentially reliable indicator of a recession following sometime within, let's say, 2 to 3 years after the inversion event. So even by statistical observations, we're not necessarily anywhere close to a recession right this moment, but it's possible. And we've also discussed on our show before that a yield curve inversion could be an indicator of a recession. Doesn't mean that a recession is coming for sure, but it's an indicator. And what they really tell us is what I just said, basically, that the market thinks that over the next 30 years, the rate for, let's say, 1-year treasuries, or if we look at even shorter maturities, the Fed funds rate, basically, the overnight rate for banks who have money at the Fed, the rate at which banks borrow reserves at the Fed is going to be somewhere on average around 2.61% over the next 30 years. So they could be higher during certain periods, lower during others. But that's sort of what the market thinks the average is going to be. And that in turn tells us that the market doesn't expect inflation to be very high over the coming years. And I'm saying the coming years because whatever rates will be earlier from now versus later from now will have a bigger impact on the 30-year rate, because over time the significance of rates that are further out in the future diminishes. But to answer your question, generally it's inflation expectations, and those are coming down, especially now with new readings of many. In fact, I think there was some new estimates that the GDP for Q2 won't be very exciting, and that, of course, then rules out or makes rate increases unlikely, and as a corollary, inflation is likely to be lower when economic activity is lower. So those could all be reasons as to why these long-term rates have been coming down.
Why does Peter Schiff say they're coming down? Or why do we think Peter Schiff is saying that they're coming down based on what we've heard from him? I'm not inside his head. I don't know exactly what he's thinking. But
well, what I've heard, what Austrians generally say is, well, it's because of QE, and that's it. Because the Federal Reserve is buying treasury bonds, those rates are coming down, which is very unlikely because the amounts that they're buying versus the amounts that are daily sold and bought on the market are quite different. You know, the amounts that the Fed is purchasing are announced, and they're relatively small, something like maybe 100 billion or so. So they would announce, okay, we're going to buy 200 billion of treasury bonds over the next 2 months, and the entire market knows it, and so it's completely meaningless. And also the total market is something like, I mean, the U.S. debt is something like 22 trillion. So it's kind of a drop in the bucket if you observe it big picture.
Mm-hmm. So how much of all this rigmarole about bond yields, whether that's long-term or short-term, how much of it's economic and how much of it is political?
I mean, I would say it's a weird mix of both, because actually if the politicians were making logical choices, we've explained that the Federal Reserve should just declare one rate. It could be 0%, it could be 0.25%, just to encourage some profit-oriented thinking on the part of the lenders. But there's no need to doctor around on the rates. They could just declare one rate and leave it at that. And with that, we wouldn't have any of this. We would not. I suggest that we wouldn't have big fluctuations in any of the maturities. But if I'm wrong, then that would mean that these rates are moving mostly for economic reasons. Now, since the Fed claims to be fighting or claims to be preventing inflation by raising rates and or increasing inflation by lowering rates, the market's expectations of inflation, which is an economic factor, has some sort of impact on this rate, but only because the political decision is to follow the inflation expectations. If they said, no, we don't care, then the rates probably wouldn't move much. If that makes sense.
Oh, I mean, it makes sense to me, but we've been talking about this for 30 episodes.
Right.
So what else do we need to know? Or what else can we explore about this idea of these long-term yields? Because the feeling that I get, and I have a hard time understanding this stuff, Nima's the economics junkie, not me. When we start getting into the nitty-gritty of this sort of thing, I'm just kind of like, hey, Nima, explain this, which is what I'm doing right now. But it seems to me that in general, both the neoclassical economics paradigm, which is the one that dominates the mainstream thinking, and its supposed arch nemesis, the Austrian economics mindset or paradigm, both of them freak out about these yields, about whatever they're doing. And it seems that the MMT camp is kind of like, yeah, whatever. I mean, maybe they kind of sort of do something, but they're not the important thing.
Right. We can Read from Pragmatic Capitalism about whether the bond market is predicting recession on that token.
You sent me that link, didn't you?
Yeah.
Let's see here.
I can read it right now.
Oh, go for it.
So the article is called "Is the Bond Market Predicting Recession?" A lot of people seem to think that the bond market is forecasting a recession now that yields are declining again and the curve has completely flattened. Is a recession coming? Do you need to jump in your bunker? Do you need to build your bunker? Let's explore. I've touched on the flattening and inverting curve a number of times in the last few years. Here's my general view over time. November 2017. The curve isn't inverted, no recession is on the horizon, and you don't need to worry about recession until well after the curve actually inverts. March 2019, the curve has finally inverted by some measures, which increases the odds of recession about 18 to 24 months out. But don't go panicking just yet. So by the way, he's suggesting here the curve has inverted by some measures. It's not that the 30-year rate has come below the 10-year rate or anything like that. But I think there's some kind of inversion between maybe the 2 and the 5-year-old or something like that. Actually, might as well look that up right now. Where are we inverted right now?
See all this stuff? This is all Nima's stuff. I'm just here for the general ideas, but if we're getting down to, is it the 2 or the 5-year is the thing that's inverted, and the 30-year, yeah, Nima, totally Nima.
Yeah. I think it's something like between the 2 and the 5-year-old or some small inversion, but we don't really have a big inversion yet. Anyway, reading on. In short, don't shit your pants just because some media outlet is trying to scare you by misrepresenting a fairly well-established indicator of recession, right? But the media, otherwise, you should always take their word for it whenever they tell you something.
Anything.
But where are we? Yeah, they're upstanding, honest people. They're just really cream de la cream of society. But where are we now? Well, it depends on how you look at it. For instance, the most common curve comparison between 2 and 10s actually doesn't show inversion yet. Other measures do. In any case, this isn't an on-off switch. It's not like the curve inverts and some magical thing happens to the economy where recession becomes inevitable. No, you have to think like a bond trader here, and you're in luck because I happen to be a bond trader. In fact, I'd argue that one of the only things I've become really good at in finance is understanding and predicting interest rates. What I see is more of the same that I've been predicting for a long time. Low inflation for longer. Except that it looks like the economy might be deteriorating marginally as trade worries and a housing slowdown take fairly anemic growth down to anemic growth. So you have very modest inflation concerns turning into continued low inflation concerns. And so long bond yields have compressed again as bond traders essentially predict low future inflation. The way that shows up in the curve is a modestly rising curve to one that is now flattening. In other words, it is a slow and steady decline in the belief about future growth and inflation, but not necessarily a sign of quickly deteriorating economy headed for disaster. What isn't clear in all of this is whether recession is on the horizon. In my view, recession cannot be predicted merely by looking at the yield curve. You need more corroborating evidence in the coming 18 to 24 months, roughly the amount of time we typically see between inversion and recession. We're not there yet. But growth is definitely slowing. Inflation is not a worry at present. To put this in some perspective, here's a good chart from the Fed on using the curve as a recession indicator. The current reading is consistent with about a 35% chance of a recession, a reading that has been rising steadily in recent years. That's also consistent with the ORCAM recession index. Importantly, the ORI is an on-off indicator, meaning that a reading under 100% is a no recession prediction. So I wouldn't read too much into the curve inversions and falling yields just yet. They're a sign of more muddle-through, slowing growth, and weak future inflation, but not necessarily a sign that you need to lock yourself in your bunker and plan for the end of the world. And then here's a footnote. Building a bunker is expensive and probably not a great investment. Besides, you don't want to die with the rest of us instead of living... Besides, don't you want to die with the rest of us instead of living in a hole in the ground? Okay. And it's also what's also interesting about this, because of course there's more uncertainty now about the likelihood of the tax cuts becoming permanent or any new tax cuts, which are needed in order to bring back economic growth, in our opinion. And in particular, that's probably because Democrats have a majority in Congress, because the outcome of the 2020 election is unlikely. So for those reasons, right now, it's kind of like a standstill from the
economic outcome of the 2020 election is unlikely, or did you mean uncertain?
Oh, uncertain. Sorry.
Yeah, got it. It's unlikely we'll have an outcome of the 2020 election.
Right. It will just be a dictatorship by then. Yeah. So for those reasons, we might have people on the markets factoring in slower growth or declining growth, because the growth factors aren't currently as present as they maybe were before the 2018 congressional, or was it 2019, whenever they had their congressional elections. And that's what I've been saying ever since. The Democrat majority in Congress has definitely thrown a wrench in many economic plans of the Trump administration. And, whether there's going to be compromise on economic programs or not, we haven't seen much of it, I guess. I don't know where we're going to be with infrastructure and, most importantly, the tax cuts becoming permanent. That kind of stuff we don't know at this point.
Permanent and greater.
Permanent and then some. Yeah. Exactly. Because we're in this permanent drive towards austerity. Any deficit is immediately concerning. Ideally we want to have a balanced budget or a surplus. These are how people think, and these are how the mainstream media and the financial media report these things. So we're in a constant pro-austerity push, with sort of maybe a Trump administration opposing that, and now we have a government in Italy that's opposing that on the European side. But the drive towards austerity is just so big, because there are apparently forces that want to cripple the Western economies, and that's what austerity will do to them. It has been doing to them.
Slow and steady.
In a subtle fashion. Slow and steady. Muddle through and decline. Yeah.
Well, Nima, do you have any last Peter Schiff jokes? I think we covered it was short and sweet on this one.
Yes. No, I think we're good, and I think we covered why following the Austrian school too strictly doesn't really help you much with your investments, and so you should venture out and gather new information every day, everywhere, as much as you can.
And don't freak out about what was the 2-year and the 5-year
the
yield curve, inverting yield curve.
Right.
And don't buy a bunker. Unless you're going to throw a party in it and invite us, that'd be pretty cool.
Well, unless it's a gold bunker and you get it below the melt value.
Okay. With that, this has been Amagi. I'm Dylan Moore with Volitional Science Network, that you can find on YouTube. And that over there is Nima Major of economicsjunkie.com. Thank you again for listening, and we will see you next time.